All right. Hello, everybody. Welcome back to another episode of the Market Close. It is Thursday, September 25th. We are live, and we're ending out on a relatively wobbly day in the stock market. Market open was bad for like 15 minutes in terms of the 9:30 to 9:45 drawdown. Then we kind of Uno reversed, and S&P ended up basically breaking even. And now we're back down. S&P down about 0.59%. At one point, it got to 654. Right now, it's at 657. Grab got to 599. Now it's back at 625. Palantir actually green on the day after hitting 184. Tesla is getting hit, down 4%. Nvidia down a little bit on the day, basically break even. And then Robinhood down about 3%. Google as well, down 0.5%. SoFi 2808. We got a lot of different macro headlines to get into, and very curious if people bought, sold, did any action in terms of managing their portfolio. But it's really not that different from yesterday. I mean, I know it's been an up and down ride, a little bit of a roller coaster throughout the day. But when you take a sort of bird's eye view of what the market ultimately looks like right now, this is it. And as you can see, Apple's green and everything else is kind of red. Healthcare took a little bit more of a hit ever since the market opened. Financials are flat. Defensives are flat. They were a little bit more green. Apple kind of breaking out. Maybe there's some stuff with Apple and Intel. Everything else relatively red. And again, on a day like this, I feel, as cliche as it is to say, it is healthy after 2 months of green to get a bit of a pullback. It's not even really a pullback, down 0.5% on the S&P, but you got some people taking some profits, which is okay. AMD, 161. This bad boy got to 154 in the morning. So some pockets of the market have rebounded very nicely, like in Apple. That's up about 1.3%. It was at 251. Now it's at 255. Other pockets of the market, like crypto, have not done that well. Ethereum, 39.23, not been the best. BMNR got all the way down to 47. Now it's at 49.42, kind of where it was at the end of the market open. It was at like $50.20. So this one kind of oscillating between that 47.40 range. MicroStrategy just got nuked today. Bitcoin right here at 109, falling below 110. MSTR last time I checked was 294. MSTR is at 302. So breaking back above 300, but still down 7% on the day. So yeah, a little bit of an ugly day, but also likely a day that we kind of needed in regards to all the momentum and green that we had, which I don't think is that crazy. I'm seeing a lot of people say they bought some BMNR today. Seeing some people saying they sold some BMNR puts. We've got some Marvells. We got some Intels. Intel was up 7%. Are we still up 7%? By the way, today's the start of Macro Thursdays with Kris. Wow, Intel 34. First time it hit 34 in over a year. Not that bad. That's up 9%. So at around 4:20, Kris will join. And we will do our Macro Thursday segment. There's a lot of macro stuff to discuss and get into in regards to interest rates, housing. We got housing data today, inflation. We had a bunch of Fed speak today. So we'll talk about all that with Kris when he joins in about 30 minutes. We also have Mr. Tom Lee, who I did not think would be live today because he's in South Korea, but he's back and he has some thoughts on what's going on in the market, along with responding to what Ken Griffin said, which, well, he's thinking it's a little .com bubbly-ish in certain parts of the market.
It does take us to our talk of the tape. .com bubble in this moment. All right. And let's take a step back at the moment. All right. And has it gotten out of hand? Here's what the billionaire investor Ken Griffin of Citadel said on CNBC earlier today in an exclusive interview.
There's obviously echoes of the .com bubble in this moment. All right. And let's take a step back. The .com bubble, there was a huge amount of capital that flowed into what today we refer to as the internet. Now, the true winners and losers were not readily identifiable at the start of that whole bubble. But move forward 10, 15, 20 years later, there's no doubt that the world was radically transformed by that moment in time.
All right, that's Ken Griffin. Now let's welcome in FundStrat's Tom Lee.
Opportunities within AI, but it doesn't mean every company that has an elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998, because 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is NVIDIA trades at 26 times forward earnings. Cisco at that same exact moment was at 60 times, and Cisco's PE peaked at 210. times forward earnings. So NVIDIA to me is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation isn't created equal. And I'm not especially clear as to whether
That wasn't Wi-Fi, dude. I got another phone call. Dude, my phone has been on Do Not Disturb for like 9 months. And for the past couple of days, I've decided to turn off Do Not Disturb for whatever reason. And suddenly everyone calls during the show. Like, I don't understand what's happening. And someone's calling me from college, bro. I haven't talked to them in like 2 years. Like, why are they FaceTiming me right now? Like, what is happening?
Mr. Griffin
Maybe they're asking if they should buy Oracle or something. I don't know.
looks at the valuations of an NVIDIA, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened, as much as he looks at other names which have gone, parabolic and they're related to AI. And that's where he says, whoa. We're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to NVIDIA and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Like, let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce, I got to give it the N=1 valuation?
I mean, I think he looks also at a stat like JP Morgan Asset Management's Michael Sembelis brought to us today.
We'll finish up with Tom after the bell. He goes a little bit more deeper into valuations, but at its core, again, even Tom is acknowledging what Ken Griffin said, which what Ken Griffin said wasn't like an issue. He basically said there are elements that are starting to remind him of the dot-com bubble. That doesn't mean we are in a dot-com bubble, but at its core, his argument is, hey, the internet was really important, but there were certain things that were getting a bit aggressive back in 1999. And there are certain stocks, whether it's the big energy names that people are claiming are a little bit too richly valued, whether it's the quantum names that people are claiming are too richly valued. There's a ton, an open door. There's a ton of different pockets of the market that Ken Griffin's pointing out to say, hey, this feels a little dot-com bubblish. Now, again, Tom Lee's argument against this and the common response to this is, wait a second. Even if all of those sectors were to go to zero, not even the stocks in those sectors, but the entire sector were to go to zero, it would not make a difference, because it's not NVIDIA that is the one that's being hit. It's not Google that's the one that's overvalued. It's not Microsoft that's overvalued, which exactly was the same case in 1999. Yes, pets.coms were overvalued, but also the Cisco's, Microsoft's, Intel's, et cetera, were overvalued. And that's the difference right now, which is, the sort of the common argument that we've been talking about over the past couple of months. And on a day like this, I think, as the S&P falls a little bit, you start to see that argument get a little bit more attention, but at the end of the day, the multiples are just not the same. Now, granted, when you see stuff like this, Oracle spending $15 billion or raising $15 billion of debt through offering corporate bonds, you start getting people to say, wait a second, now the big tech companies aren't using their free cash flow to finance all of this CapEx. They are tapping the debt markets, which was very reminiscent of 1999. That's a fair point. Granted, this is only Oracle out of the hyperscalers, and Oracle's not even really classified as a hyperscaler, that's taking out this much debt. Every other company, whether it's Meta, Amazon, Apple, Microsoft, they're all doing it through their free cash flow. And as long as Oracle is able to get an ROI on this, then that's what matters. But time will tell to see how that ends up playing out. So we're gonna see what ends up happening. But on a day like this, it's just not that psychologically, I think, impactful for the broader markets, unless we were to see like a real drawdown. Maybe people are a little bit more skeptical of putting capital to work just because they want to see what happens in October and they want to see how September plays out. But I don't think people have fundamentally given up on the bull thesis with the S&P down 0.5%. Even though there's obviously a lot of people that are claiming that to be the case. FRMI is going public in a week. We have not looked at the stock yet. I have not even read their S1. They are a Texas energy company. So we'll see what ends up happening with some of these energy names. SLNH, this one was down 16% on the day. What about an IREN? How did that one finish out? 46, down about 2%. You had a Bitfarms that was down about 3.6. Again, Oracle was down on the day as well, 5.5%. Oracle also got a sell rating from Rothschild. They initiated a 175 price target, and they were like, all of this AI RPO nonsense is not going to be real, not going to materialize. So that's probably another reason why Oracle took a little bit of a hit on the day. LAC, this one's been a big one. I mean, really the place to hide in the midst of the past couple of days is whatever Trump's been investing in, which is probably Lithium Americas. We don't know if it's official yet, but that's the rumor. That's up 22%. It's up 80% for the week. And then you've got Intel, that maybe there's some news coming out after hours, $33.99. One piece of news on Intel right here is that Intel has approached Taiwan Semi about investments or manufacturing partnerships. So it looks like they're going to Apple, they're going to TSM, they're going to the US government. They just got a $5 billion investment from NVIDIA. They got $2 billion from SoftBank. I mean, Intel is really trying to reinvent itself here and try to figure out how they can re-engage the ecosystem for building chips. So maybe that's why that stock's moving a little bit. But the Apple partnership or Apple investment so far not confirmed. And we're going to see if that one ends up playing out. All right, we got 2 minutes. NVIDIA 177. We'll finish up with Tom Lee after the bell. Kris will be joining in about 20 minutes, and we'll get all of his takes on what's going on in the macro. There's a couple of other headlines, nothing too crazy. Also, yes, Costco. I forgot Costco. So, I mean, look, the implied move on Costco is usually like 1%. So we'll see if we get any big move on this 942. That's down about 0.27% of the day. But as long as they deliver good earnings, which is pretty much all that matters for Costco, then hopefully that stock is relatively stable. So we're gonna see. Yeah, maybe they announce a split, dude. That'd be quite exciting. Don't know if they will, but that would. Let me know in the chat if anyone owns Costco. Also, we'll do a pump or dump poll. We'll see if there is any volatility for this one as well. All right, here we go. We got about 30 seconds so far. I guess this is the second ugliest day of September. The most ugly was September 1st. And it looks like today, down about 0.5% on the S&P is going to be the second ugliest, which is not that crazy. But nonetheless, that is how Thursday is ending out for September. Also, we got money market inflows that I'll check right after the bell, and we'll see what happens there. Thursday, September 25th. Thank you, everybody, for being here at 4 p.m. The stock market is now closed. All right, there you go. We are done for the day in regards to the stock market, but we also have 4 hours of after hours. So, and then after hours, we have the overnight markets, and then we have futures. So it never ends. It never ends. Let me do the poll right here in the chat on Costco, pump or dump. What are we thinking? Costco, pump or dump? Yeah, dude, the building has not complained yet about my bell. Although I told you guys in the morning, I got this email and it said like noise in the subject from the building. And I was like, holy crap, I got caught. But it was something about like construction outside. And I was like, oh, I'm okay. But eventually it's going to play out. NVIDIA, that's actually up about 0.36%, basically flat on the day. Tesla, 423, down 4%. Palantir, down about 0.2%. Robinhood, down about 3.3%. AMD ended positive, not too bad, 161. SoFi, down 1.3%. The Googs, down about 0.59%. Grab ended up going green, 626. This thing got all the way to 599. So making its way back into the 620s. It is very nice to see that for Grab. Reddit right here, 233. That's down about 1.2%. Amazon down about 1%. Meta down 1.5%. Salesforce down 1.8%. PayPal down 1.7%. Apple up 1.8%. Maybe based on that Intel news. Elf right there is up 1.5%. SMCI was flat on the day. IREN ended on the day 1.36%. Rocket Lab ended 4.5%. ASTS at one point it was down 7%. ASTS was down 9%. Okay, so broke below 50 to end on the day. And then Costco, again, we should be getting their earnings pretty soon. Don't have the numbers yet, but we likely should get it by 4:05. 9:45, slightly red after hours. MicroStrategy, nasty day. Did it go below 300? It did go below 300. Did it end above 300 or end below 300? 300.88, which really cooked Misty. I mean, obviously, it's really hard for that one to do well if the underlying asset is bad. I looked at NVDY to kind of also see, is it YieldMax's problem or is it Misty's problem? And I looked at both Misty and NVDY from May, which is kind of when I got more interested in YieldMax. NVDY was $13.50, now it's $16.29, and it's paid a very healthy dividend. Misty was 21, now it's 13. So it's really, to the best of my knowledge, not a YieldMax thing. It's the underlying asset on NVIDIA has done very well since May, MicroStrategy's been a piece of garbage, for lack of a better word. And so, yeah, it's just not the strategy that's working out at this moment. But then again, if Bitcoin flips, maybe that flips as well. Bitcoin right there, 109.4. That one's down. And then BM&R, how do we end on the day? 49.52. 49.52. That one is down about 4.6%. There you go. There you go. That is what we are seeing. Let's look at the stock draft, and we'll get back to Tom Lee and finish up with him. Same thing as always. Matt right there, 24.3, basically same as the morning. I'm at 29.7. Steve's at 3. Tanner's at 18, and Kris is at 8. So we got Matt, me, Tanner, Kris, and Steve for the stock draft at the moment. Salesforce again down 1.8. SMCI up a little bit, and then Tesla took it on the chin today. Now Elon did tweet. Tesla went public for 0.1% of its current market capitalization. So Elon he had another tweet as well. It was like someone tweeted the picture of the stock, and he was like, remember when everyone said that because the EV credit was going away, Tesla would go to zero? So, Elon is kind of publicly admitting, hey, Tesla's done really well, and he's making sure people understand that he as the CEO is probably a reason for that. And hopefully that leads him to getting his compensation package approved, which will be officially voted for at the end of November. All right, Costco, let's see if we have those results. I don't think we have them yet. Let me make sure. Let's see what the street also wants for Costco. Yeah, we don't have it yet. 580 of EPS, 86 billion of revenue. 580 of EPS, 86 billion of revenue is what we are looking for. We should get those numbers in a minute. Let's finish up with Tom Lee until, but we should be getting Costco any minute, and I'll switch over once we get it.
From his report, and he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since
Trump's going live in a bit. He's signing executive orders. I don't know what he's signing, but I'll try to find out what executive orders he's signing in a bit.
GPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. I mean, just to give some perspective, NVIDIA is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies are excited about, if companies are saying that AI is something where they're actually allocating capital, and many are, of course, are seeing productive gains, I think it's justified that would be what you'd expect to be the first wave of investment and spending is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.
I mean, I look at a stock like Oracle, for example, only to pick it out because it's up more than 30% this month. Now, it obviously had the moment around earnings where it added such a tremendous amount of market cap after that event. I bring it up if only because it was initiated sell today at one firm on Wall Street, in part because they suggest that you've got some really aggressive assumptions that are coming with this stock. Now it's down 5% today because a lot of these names in what you would consider the momentum basket have rolled over a little bit. But the notion that the assumptions are so big that there's inherent risk in and of itself within that.
Scott, I think that there is going to be moments where it feels like we're possibly topping, and today is coming at a time when we have this Oracle report and stocks are generally soft. But number one, I think it's always really healthy to see corrections in a super cycle. But I do think it's really difficult for someone to actually ring the bell at the top. And in fact,
of course,
whether we
always.
Yeah, like if we look at Palantir or Tesla or NVIDIA, I think that there have been, 25 bell rings at the top at every waypoint along the way. To me, I think the real test is going to be that we see a day where investors are convinced there's absolutely nothing that is wrong with the thesis and it's bulletproof, and yet stocks make announcements and they go down and companies actually have negative returns. I have not seen that yet. In fact, to me, it's reflexive to see that every time markets flatten out after posting gains, we have a lot of people declaring the top. To me, that's a really healthy sign that there is very little conviction about this bull market. And I do think it's healthy to actually see skepticism. So I'm not opposed to seeing like these reports, but it's healthy.
Do you think that equities are especially vulnerable here, as we wrote in our intro today, as BTIG suggests they are the most since the April low? Do you feel the same? I should also mention it comes within the same context of commentary recently from the Fed chair, who didn't go out of his way when he answered the question about the equity markets to suggest it's wildly overvalued. But nonetheless, he did say that stocks are fairly highly valued. He could have said, I think they're fairly valued. He didn't. He said they're fairly highly valued when he answered that question. You put that into the mix too when you consider your answer.
Yes. Well, I have a lot of respect for Fed Chair Powell, but I don't remember the last time any FOMC member actually said stocks are attractively valued, because I don't think it's their job to comment on equity valuations that way. And if we think about where, again, market valuations are, I'd be very concerned if the most important stock like NVIDIA was trading at a multiple that couldn't deliver returns. But it's the most important company in the world, 40% plus revenue growth. It's trading at 26 times forward earnings, which is hardly demanding for a company that makes a product that every single company in the world that is involved with AI actually needs. They can't replace it with anything else. So I don't think it's expensive. When you ask about April lows and valuation vulnerability, I think there's really two big differences. One is monetary policy was actually quite tight in April, and the risk was actually the Fed wouldn't even consider intervening, and yet markets managed to stage a 30% rally. Today, we have a Fed that's not necessarily pounding the table that it's in a dovish cycle, but they've understood that they need to now use their hand to support employment. That's a sea change, actually. And as we know, ISM's been below 50 for 31 months. It's the longest stretch in the history of the ISM index. I think if the ISM breaks above 50, that's a recovery in confidence in capital spending. That would support a broadening of the economy, and I think that would be good for equities.
Well, speaking of Fed policy, and you stay with me, Tom, for a moment, Ken Griffin also gave it.
So there you go. That's kind of his major argument. He basically said, I don't care what Jay Powell has to say, because Jay Powell is not the determining factor on what happens in the stock market. So, I mean, there's a variety of different macro things that have caused a little bit of the weakness over the past couple of days. We have to talk about the housing situation, because Fannie Mae, they came out today and they said some things around interest rates and mortgage rates in particular that definitely affect housing stocks. So we'll discuss that. But in general, if 2 days ago when Jay Powell said his comments about stocks being fairly highly valued, being the sort of catalyst to at least start some of the selling momentum, yeah, Tom Lee's saying that just doesn't matter as much. Which, look, I agree with as well. I mean, Jay Powell's allowed to have an opinion on the stock market. The Fed tries to, be as apolitical and not really talk about those things. But you can say the stock market's fairly valued. I think that's a fair point for anyone to say. It's just a question of, does the market now need to sell off because the Fed chair, that is not the end all be all when it comes to the way markets work, is that the reason why we sell things off? And at least today, dude, like in the midst of all this discussion around bubble, capex, all this stuff, like we are down 0.5% on the S&P. This is, again, it's a dip for ants. It's not really something that I think people are feeling in a fundamental way. If anything, a lot of people came in and bought the dip, and either that's going to be the right decision over the coming days and months, or that's going to be the wrong decision. But it's just not enough for people to say I'm out of the market. I mean, the dip buyers really did step in throughout the day. Even though we ended red on most names, it just wasn't as red as what it was in the morning. Costco should be out in 3 minutes, 4:15. We should be getting that. Again, I don't really expect a lot of volatility. Fear and greed, by the way, is back to 52. We were at greed yesterday at 63. So that one has flipped to the other side. And we're going to see what Costco ends up saying. Yeah, BM&R was down about 5% on the day. Again, ETH falling below 4,000. Dude, this thing, or now it's not even just below 4,000. It's at 3,890. So it's below 3,900. Bitcoin as well. $230 million has been liquidated today alone in the crypto markets. I think on Sunday it was like close to 800 million. So crypto's not been good. And to be honest, Robinhood's holding up pretty well, even though crypto's not been the best. Bitmine right there, 49. I would say even Bitmine holding up decently well. I know it's been a tough week, but with ETH down this much, it's still trying to hold the high 40s. But obviously the MicroStrategies, the Coinbases, all of those names getting hit as crypto takes a bit of a hit. Bitcoin and Ethereum themselves. So that's what we have there. Rocket Lab, really? Acquisition, acquiring Myranic AG for up to 150 million. Okay, they just raised 750 million in debt. They're now acquiring a company, Myranic AG. Never heard of this one. Laser communication. Space laser communication is what Myranic AG does. Develops and manufactures laser communication products for aerospace-based communication networks for governments and commercial markets. Okay. That's old news. How old is this? Is it that old news, or is it? Well, maybe it's too old. Or maybe it came out a couple of weeks ago and we missed it. But I did not know they acquired this company. So there you go. I know the Geost acquisition was a big one that mattered. But this one was a smaller one. Costco, do we have it yet? They finalized the deal very old. Okay, so that's probably why it came across the feed. They finalized the deal today, likely announced it a while ago. Seems like it's final today. Costco, do we have the numbers? 415. Oh, we got a little bit of a pump. 0.5%. That is going to retire a decent chunk of people. Let's see the numbers. Costco, okay, we got a beat and a beat. 587 versus 580. That's a beat by 1%. 86.1 versus 86.06. That is a beat on revenue. Okay, there you go. A beat and a beat for Costco. not too bad. Costco revenue's up 8% year over year. EPS is up 11% year over year. They don't have the official results on their website yet. Then we'll get a little bit more deeper, but there you go. Not too bad. Costco is doing nothing after hours. Yeah, Steve's retiring tonight based on this. Yeah, dude, it just like it's Costco. It goes up over time, but it got, even Tom Lee mentioned in that clip, Costco trades at 50 times, Walmart trades at 50 times, Nvidia still trades at 26 times, which is not bubblish. Like I don't know what person looks at Nvidia trading at 26 times and be like, oh, that's a bubble. It's like, no, if it was 45, 50, 60 times, okay, like, but 26 times, either they can't get to that growth to make the 26 number make sense, and it's a bubble, or you just think you shouldn't pay more than like a 10 PE on any company, which is just not the current state of the markets. But there you go. Costco, no one's buying, no one's selling, but that one is green. We got some updates from Trump. We don't have the executive orders yet, but here is what he said today that got a lot of people talking about tariff revenue and the farmers.
We're going to take some of that tariff money that we made, just to get off the subject for a second. We're going to take some of that tariff money that we made. We're going to give it to our farmers, who are for a little while going to be hurt until it kicks in. The tariffs kick into their benefit. So we're going to make sure that our farmers are in great shape, because we're taking in a lot of money. We're finding the other day, it was very interesting. They found $31 billion. They said, sir, we found 31. I said, you mean positively, right? They said, yeah, 31 million more than we knew. And they said, we don't know where it came from. I said, check the tariff shelf. They came back the following morning. They said, "You're right, sir. It came from the tariffs." We've never seen anything like this. So what we're going to be doing is we're going to be taking some money from all of the tariff money that we've taken, and we're going to distribute it to our farmers until the tariffs kick into their benefit, which ultimately the farmers are going to be making a fortune. But it's a process of it has to kick in.
So you got some of the farmers potentially benefiting from the tariff revenue. I don't know the specifics on how exactly that's going to work out. Trump has had a long and dicey relationship with the farmers going back to the 2018 trade war with China. There had to be a little bit of a bailout there for farmers as well. So, I mean, you could say some farmers that lean more conservative like Trump, but a lot of farmers have historically not been the biggest fan of his policies. So it looks like if the tariffs are impacting any of the agricultural production, that would be something that Trump potentially resolves via the tariff revenue. All right, one last thing I want to show everybody before we get Kris onto the show, and this Kris and I will probably talk about as well. Fannie Mae came out today, and they said something quite incredible. They said if we want affordable homes again, one of three things must happen. Prices on homes must go down by 38%, which I don't think anyone who owns any property would like to see. I would like to see it because I'm renting right now, so that would be great. But I don't think anyone else would want to see it. Incomes must rise by 60%. I think everyone would love to see their incomes rise by 60%, but that's likely not happening either. Or, and this is the part that Bessent and Trump are obsessed with, mortgage rates must crash by 415 basis points. So you got three different scenarios, two of which just seem very improbable. I mean, they could happen, but it's unlikely. The other one, potentially very likely if Stephen Moran gets what he wants done, which is interest rates coming down to 2.5%. But this is from Fannie Mae. This is from a government agency coming out today and saying, hey, according to our calculations, if we want to get affordability on housing back to 2016, 2019 levels, it's not easily going to happen. And I know the housing sector has been doing well over the past, at least past month, right? With the August data being way better than expected. But for it to get back to a level where at least Fannie Mae thinks it would be actually affordable for the average American, you're going to need one of those three things to happen. And we just don't know if it would easily happen in that way. So having said that, let's bring on for the first ever Macro Thursday segment. We're going to do this every single Thursday. Our friend Kris Patel, get his thoughts on the housing market, quantum, interest rates, inflation, everything that's going on. And we will keep going from there. Kris, what's up?
Dude, I was looking at the stock draft last night and I noticed a very funny trend. If you look at the performance, it's actually kind of skewed towards our ages. So if you look at the least perform, the person that's most underperforming, it's Steve, and then me, and then I think Matt, or is it Matt Tanner and Matt, and then you're winning right now. And it kind of shows like the battle scars that each of us has picked up has basically like created the investment like picks that we have. Like, okay, so like an example for me, like I have a bunch of healthcare in my portfolio, like UNH, Eli Lilly, Novo Nordisk, right? Take Two, which is for GTA. So like those are like my bread and butter kind of things I grew up with and everything else, and that I'm well versed with. Like if you look at Matt's got some energy plays in there as well, right? That like EOG. He's got what is that they call Berkshire, who has like a large portfolio with that. Each one of us, depending on what we're picking, actually shows as the younger you are, the more optimist.
Well, explain Steve and MicroStrategy, because I didn't get that when he picked it, and I still don't get it today.
That's because Steve is tactical. Like there are times where Steve comes up with the most prescient ideas that are just phenomenal. But, and if you look at his portfolio, they're more value-based plays. Like CRM is value. PayPal is value at this point, Yeah. So, and value right now is not catching the bid that.
So are you saying I'm the degen for Palantir Hood Tesla?
No, I think you have a portfolio that's like it's like the eternal optimist portfolio where you don't care about PE at all. You're like, fuck earnings, I don't care about that shit. Or PE doesn't mean anything. Like Palantir's got a PE of 600. It doesn't matter. We don't need to make money for the next 600 years. It's okay.
Oh my goodness.
You know, Hood is like 100 PE. Tesla's like all the metrics are going in the other direction, but fuck it, the robots, it doesn't matter. You know, AMD is like the laggard. Well, technically they're coming back right now. I'm telling you, your portfolio is just full of all of the, I don't know, like the eternal optimist plays, and they're working out right now. And it's kind of the same thing with some of the other like portfolio plays. Each of us has our own different investing style, and if you look at each one's investing style, it kind of like ports into our ETF picks. So, yeah.
All right. Well, look, I'm excited to do this. I think we did this a long time ago. We used to have like a little segment like this, but life got in the way. We both got distracted. So I'm happy we're committing to this every single Thursday. For those that have topics, definitely put in the chat. We'll try to make sure we get through them every week. But this is the segment of the close every week where we really want to dive deeper into macro data, look at a lot of charts, try to understand it, and then go from there. So I think let's start off with this broad-based topic, and we'll get nitty-gritty. The Fed and interest rates. The main Fed speak I heard today was two things. One, concern that the Fed won't cut in December, or like concern that we won't get another 50 bips of cuts. And then you had Moran, who went on Bloomberg and said, no, we need to be cutting 50 bips every single quarter or every single meeting. And you have a confliction of narratives there that's also potentially affecting the 10-year, affecting the stock market. And then you get Jay Powell saying what he says. What is your current take on interest rates? Do you think we're going to get enough cuts by the end of the year? And I guess, is Powell really too late based on the labor market, or do you think we need to slow things down?
No, I think, okay, so there's two schools of thought here. The old school Fed of thought is we need to be data dependent, and the data is basically saying, hey, everything's okay right now. So the current, like a lot of the people on the board are just looking at existing data. Stephen Moran is looking at data a little bit further ahead. If you look at Scott Bessent, he's looking ahead. And if you look ahead, the data is very clear that there are challenges that are coming our way. You're starting to see the labor market cracking. And let me actually bring up the labor market data so I can show you what these guys are seeing that's causing them a bit of a worry. And that's something that, in my opinion, I think Stephen Moran is right. I'm not sure I'd agree with him on the pace of those cuts, which is 50 basis point cuts like every other meeting, because I think that might signal to the markets that things are just not doing that well. But okay, so the first thing we're just going to look at right here is just what is this? Unemployment. Okay.
By the way, Costco 938 taking a little bit of a hit after hours.
So if you see long-term unemployment, like people that are unemployed more than 27 weeks, it's growing, and it's a sharp rise since May. In May, it was around 20%. Now it's about 25%. So you're seeing a lot of people that are unemployed are starting to not be able to find jobs. You even see it on TikTok and all these other social media platforms where you're seeing a lot of like younger people that have been laid off like 6 months ago. They're not finding work right away, and that's a bad sign, because that's showing that there's a deterioration in the labor market. So one of the reasons why Stephen Moran is actually saying that, and same thing with Bessent, is because this sharp rise is not good. One of the other things that they also mentioned, which I thought was actually very interesting, was just the amount of employment skews that the last administration kind of gave us. And let me show you that. And once you see it, it's like, what the hell? So like this, you can see like, oh my God, look, job growth, it's nice and linear. Everything is going up, right? The problem is, if you see where the growth in in jobs have been coming from, this is the federal government, which if you look at all the way in 2005 was about 2.7 million people. It got to about 3 million. And then since then, the number of federal employees has been kind of going down. The bigger thing is, during the Biden administration, look at the jump in state government employment.
This is probably what was juicing up a lot of the job numbers every month.
Right. And if you think state governments were jumping up, look at local governments, like look at this jump right here. Crazy, right? So our population has grown, but it hasn't grown like crazy amounts. But you know what has grown? All the services that we provide to the what are they called? The migrants and everything else. So yeah, what happened? A lot of state and local governments got a lot of funding from the federal government. So they were just pumping out money right and left, hiring people. And the challenge is now you've got a bunch of areas where property taxes have gone up significantly. And everyone here in the chat who was a homeowner, you know exactly what I'm talking about. Property taxes have absolutely exploded because the value of your homes have gone up. Like if you look at certain properties here in Atlanta, you know, a $500,000 house now goes for $800,000. And so the local government's saying, hey, our property taxes are going to be based on your $800,000 assessment. Well, the person living there, they're like, wait a second, like my income hasn't gone up that much to justify that giant increase in property taxes. Well, one of the things is the state and local governments, because they got fat and happy with one, the federal government throwing money their way. And then on top of that, property taxes going up. So now you've got all this additional cash flow coming in. They're like, hey, we don't need to be careful on how many people we hire. We can hire as many people as we want. The challenge that you run into in that scenario is that if you get property prices that start crashing, like 2008, look at the property prices started to go down. Local governments had to cut back. They had to actually let people go because you couldn't keep the wages in the area because the property prices go down. So your state, your taxes go down. And then it's like almost like a doom loop that happens. And the same thing on the state side. If you just take this away, same thing, state taxes, as revenue comes down, they have to adjust their employment. So you can already see, look on the state side, some controls happening and coming down. So this is something to just be mindful of in the current scenario where there is more of an emphasis on taking people that have been really supported by a lot of government spending, both at the local and the state levels. A lot of those people might end up, you know, in the private side, in the private sector, if all things go according to what they want. So yeah, my recent property tax assessment went up 30%, and I'm sure, Jeff, your income hasn't gone up 30%. You know,
so what is the implication from this in terms of how you think of I guess interest rates, or is this more tied to the labor market for you?
So this is a couple of things. So number one, state and local governments, they also have to do municipal bonds, right? So one of the ways that you can kind of cushion the impacts of what's coming is, number one, if you lower interest rates, those state and local governments can theoretically issue more debt at cheaper prices. Because if you have to issue debt at a high price, that means that now more of your tax revenue, instead of going towards services, is actually going towards paying the interest on that debt. So by lowering the interest rates, one, you boost state and local governments, or at least give them a cushion, not necessarily prices going, I mean, not necessarily like losing money, but basically the impact will go the other direction. The other key thing is property taxes. Like, you do not want a housing crash right now. If you get a housing crash where, you know, according to Fannie and Freddie, there's a 30%, dude, if properties go down by 30%, that means that a lot of these state and local governments, they're going to lose a lot of revenue that's going to be coming their way. So that's the other thing. So you kind of want to support the housing market. Now, I think what the Trump administration wants to do is, it's going to be a nice soft landing. And the way that you get there is by, if you lower the interest rates, shelter prices will not have to decline that much to make housing affordability a thing anymore, right? So because interest rates are coming down. On the other side, you don't want home prices to go absolutely berserk higher. If you just lower interest rates to 0%, now everyone's going to be buying a home at 0%, and you've got a huge problem there, right? So you don't want to do that. So you have to do everything in this weird measured way, right? And then you also have this deflation happening. And I think Stephen Moran pointed this out, and this is what I've been banking on. The amount of rental vacancies is starting to climb up. Okay, now what does that mean? That means if rental vacancy is going up, naturally rent deflation should be happening in a lot of parts of the country that are having that thing. The other challenge that you're running into.
Kris, let me just stop you real quick. Let me just play this 2-minute clip we got from Trump officially, executive order signing for TikTok. That's why Oracle's getting a little 1% hit to the upside, and then we'll get back to macro stuff.
We have an executive order TikTok from the first days of your administration. You've charged a team from your administration, led by Vice President Vance, with ensuring that we can preserve TikTok as a platform for the 170 million Americans who use it, while ensuring that their data is properly protected as required by law. With this executive order, you will be effectively bringing into effect the agreement that will save TikTok and ensure that it can operate safely and securely.
So this is interesting because I had a very good talk with President Xi. A lot of respect for him. Hopefully he has a lot of respect for me too. And we talked about TikTok and other things, but we talked about TikTok, and he gave us the go-ahead. You know, it's run by American investors and American companies, great ones, great investors, the biggest. You don't get bigger, I don't imagine. And maybe I'll have JD. JD was very much involved and in charge of it. And maybe I'll have you say a few words about the deal. He would report back, and the points of the deal, I think, are great for our country. So JD, do you want to give it a little talk, please?
Yes, sir. Yeah. So thank you, sir, for your leadership and for your help. We really couldn't have done this without the president actually ushering this deal over the finish line. There was some resistance on the Chinese side, but the fundamental thing that we wanted to accomplish is that we wanted to keep TikTok operating, but we also wanted to make sure that we protected Americans' data privacy as required by law, both because it's the right thing to do, but also because it's a legal requirement of the law that was passed last year by Congress. So we think that we were able to do that. Of course, we're going to keep on working at it, but this deal really does mean that Americans can use TikTok, but actually use it with more confidence than they had in the past, because their data is going to be secure and it's not going to be used as a propaganda weapon against our fellow citizens. We're very excited about it. We appreciate the cooperation of everybody involved, and it's a big day.
All right, there you go. Oracle up 2%. The TikTok deal is now official, and it looks like that was what the executive order was for today. Okay, Kris, so you were making the point about deflation based on rental vacancies and how that would ultimately affect the labor market. Oh, you're muted.
There we go. So right here, this is the historical rate of rental vacancies in the country. Okay. One of the things that happened during COVID, of course, we had this giant boom in multifamily home construction. Now, a lot of those buildings and everything else, especially in the Sun Belt, are coming online. And so rental vacancies are starting to climb now. Usually what happens is, if you have some sort of macro level event that, causes vacancies to go up because people can't afford homes or whatever, then that puts downward pressure on rents. If you look at rental vacancies, and this data is from Q2, it's actually a little old. It's back to like 2019 levels again. Okay. So this was when the housing market absolutely collapsed. So rental vacancies just shot up here and then started to come down. This number is likely to keep going higher and higher, especially if you consider the amount of people that the Trump administration is deporting. So on one side, according to the data from DHS, almost 2 million people have been deported. / have left on their own. So a lot of people are saying, well, home prices don't matter to me. Immigrants don't buy homes, but immigrants do rent. So if you own property and you're renting to, migrants, whatever, illegals, whatever you want to call it, and they happen to get deported, now all of a sudden you have to find a new person to rent your thing. And a lot of properties, they have not been cash flowing. And that's the dirty little secret. And here's something that may shock you. And this is something because you just signed a rental agreement right now. How many months did you get free?
None.
You didn't get any months free? You got G'd on the deal.
But this is one of those places where there's no negotiation. If you're
is that nice? I gotta come visit.
You gotta come over. I've been
yeah.
You try to negotiate, they'll be like, bye. We have 50 other people on the list waiting.
So what a lot of these mega landlords they've been doing, like they've been playing this game, and it's a very interesting game. So when you go and you try to get a loan, right, for your building, the bank says, okay, what does your cash flow look like? So you take all the rents that are there, and they annualize the rental income and then say, okay, this is how much you get in cash flow. This is how much you can borrow. So a lot of these guys, their vacancies started to climb. So you know what they did? They don't want to lower the rent, because if you lower the rent, number one, what's going to happen is your cash flow is going to look like it's deteriorating, right? If you were charging $2,000 a month for 10 different people, and every year you're getting that great return, now all of a sudden your vacancy rates are climbing. Now you want to make sure that you're cash flowing. What do? Well, one of the things that they're doing is they're not lowering the rent, but what they're doing is saying, hey, I'll give you 3 months rent for free. So if you think about it, that's an entire quarter. So this way you basically have cut your total income for the year, but it doesn't look like that because your average monthly rental is what people are focusing on. And it's a weird dynamic, because on the other side, you've got the cost of insurance rising fast. You've got the cost of property taxes rising really fast. And so a lot of properties, they're no longer cash flowing. All right. If you speak to any investor here, be like, hey, listen, go buy a house right now. I guarantee you maybe 10% of homes on the market at current prices can decently cash flow. Everywhere else, no. And a lot of investors have basically pulled back because of that. They're not buying homes. So on one hand, you've got an affordability crisis with regular Americans not having the ability to make the current, equation work. And now you've got investors pulling back. So you're setting up for, at the worst, a housing crash, at the best, a long drawn out period where home prices don't appreciate at the 2.5-3% per year that you've normally seen. Correct. And theoretically, from a macro perspective, that's good. And that's what Stephen Moran is banking on, saying, look, if we lower interest rates, the cost of shelter is naturally going to keep coming down. And if shelter keeps coming down, that means that that's a really big component of the housing market. So we can basically control inflation. The other main benefit that we would have by cutting interest rates, of course, is the federal debt, right? If you look at the
Kris,
spending,
before we continue that, I'm sorry to interrupt you. We got one piece of breaking news that I think you would care about, because you have a position in this company. The information reporting Meta is in talks with Google to use Gemini to improve their ad targeting. Kris got so excited on this news, he left, because he's going to sell his Google right now after hours off hearing this news. That is crazy, bro. If Meta's actually using Google's AI to make their ads better, that's why Google's pumping right now. Kris, any raw reaction to that?
Dude, when people keep showing that partnership between OpenAI, Oracle, and NVIDIA, I'm just thinking to myself, like, man, this is amazing for Google. This just shows the level of fear these guys have of what Google can accomplish, because Google is vertically integrated in this, and they don't need the other one to do anything. They literally are self-sustaining. Google's entire business model is way more self-sustaining. So, I mean, just be long Google, man.
Yeah, but this
Google
is bearish. This is bearish Meta. They're spending how many billions on all these random researchers, and they still need Google. Like, I kind of don't believe this report, to be honest. Like, for them to have to go to a competitor and use their AI because their internal AI sucks at ad targeting. Meta makes
no.
It's just on ads.
I think that's wrong. That's not the way you think about it. Like every LLM, every model has different core strengths between them. And so this could be a deal that just helps with some core strengths that Google has that Meta does not have. I mean, you also have to remember Google has some of the largest data sets on the entire planet. So in terms of ad targeting, dude, you want that kind of, you kind of want that knowledge tree. Right now, I bet you Google can tell you everything that you have done for the entire portion of your life, what you've searched on your search history.
I don't think Meta's licensing the actual data from Google. That's proprietary. I think they're using the Gemini tech.
No. But that's what I'm saying. The Gemini tech is built on that entire giant knowledge graph that you don't necessarily have with the Meta side. So if you think about it,
Meta has 4 billion monthly. Meta doesn't have
but Meta doesn't know
ad data.
But Meta doesn't know what you're searching for. Meta doesn't know that you flew to this place, that place, and especially
but Meta knows a lot of shit about you. It's not.
Dude, I totally agree. But if you're not an Instagram user, you're not a Facebook user. Like, when's the last time you logged on to Facebook?
has been.
When's the
wild.
last time you logged onto Instagram and posted how much you paid for a flight to Seattle? Google knows that. Meta doesn't, right? So all I'm saying is from an ad targeting perspective, dude, Google knows what you watch. Google knows which porn sites you go to.
Oh, I knew. See, I knew. Like, of course, that was the inevitable sentence after. Go ahead.
You know what? You
No, dude, we have kids watching. No,
all right. Well, I'll tell you a funny story real quick. So, you know, this whole H-1B thing that happened on Twitter. So I was responding to a bunch of comments on there, and for some reason, like X detected my algorithm and modified it. So, dude, I started getting every single update on like the road conditions in Mumbai. Right. And I was like, what the hell is going on here? Like, just literally, it was like I was tweeting from an Indian Twitter account, and literally my entire feed was just a bunch of Indian stuff. And I'm like, look, I care for my brothers and sisters over there. Totally with you guys, but really, I really don't need to know what the road conditions in Mumbai are and how Modi's responsible for that. So one of the things is I had to hack my own algorithm. So I went to Google and I said, okay, look, my X algorithm is messed up. What do I do? And it said, well, you know, you can just search for other things and it'll adjust it. And I have like muscle memory, so I just put Latina baddies.
Okay, all right.
And now my feed has stock information. It's literally polluted with stock information and OnlyFans Latina girls. Like, that's what it is. Remember last year it got stuck with a bunch of Asian girls?
Yes,
Now it's
I do
Latinas.
remember. Yes, I do. No, because you showed your Twitter live on the screen, and see, we're supposed to have a Macro Thursday segment in this.
You gotta have some fun with it.
No, we do have to have some fun. Your Twitter feed is helping you have a lot of fun. That is
long Latinas, bro. I'm going long Latinas.
Okay, but the point is, you don't think it's bearish Meta, but you think it's super bullish Google.
Yeah, absolutely. I think Google is going to be at least a $4 trillion market cap company within the next probably like 12 months. I would not consider count Google out by any means. I mean, they've got so many drivers in Waymo, with GCP, with all of their side hustles. I mean, yeah, I would not consider Google out of this game. So,
all right, long Google, folks. Back to 250. If this is true, and Meta is actually using, and again, I don't think it's bearish Meta. I just, for the amount of money they're spending on researchers, if it's only the AI element, something's wrong with their internal LLMs. If it's the data part of Gemini, then yes, obviously Google is trained in a very accurate way compared to, you know, any other website on the planet. But that is very, very bullish to see for Google.
yeah.
Okay, so we talked about housing, we talked about vacancies. Let's transition to the labor market. You saw the revision of 900,000 jobs, 250,000 a couple months ago. J-PAL only cut because of the labor market. Anecdotally, do you think there is a problem in the labor market? The chat can respond to this as well. And do you think we will get an appropriate amount of rate cuts to remedy the potential massive loss of jobs that are potentially coming from a weak market, number one, and then number two, potentially because of AI?
Yeah, I think that's definitely a possibility. There has to, you know, the labor market has these ebbs and cycles where people tend to gravitate towards things that are in high demand, and then, you know, markets get oversaturated, and then once the market oversaturates, they go to the next thing. So like an example is right now, in my opinion, there's a shortage in healthcare. Like, you have an aging demographic in the baby boomers, and the number of healthcare workers has stayed relatively flat over the last probably 20 years in terms of like total growth. So right now, if you go to certain parts of the country, dude, we have a nursing shortage. Like, we cannot find nurses. All right. And the cost of healthcare is exponentially rising because, one, labor costs have absolutely exploded. Why? Because instead of going into healthcare, everyone's like, hey, I want to work from home. I want to do this remote job. I want to be this, that. So one of the things that I think we're going to see is people transitioning into other sectors like healthcare that are more necessary. Same thing with like plumbers and electricians and all this other stuff. So I think labor markets, they gradually, a lot of people are always like, oh, technology is going to come and it's take everyone's jobs. And I'm like, no, everyone just tends to go towards where opportunities are. If you're unemployed for 6 months, you know, you're not going to say, yeah, let me try to find a degree. I mean, let me find a job that my MBA is going to work with. It's like, hey, I can retool myself and get another job doing something else if I just go to this program or do this apprenticeship or something else, So I think what we're going to see is just the labor market broadening out, but there's periods of digestion where you see that the population is not necessarily trained for the current need.
But
And
do you
people
think
eventually
we need
gravitate.
to, do you think we need to significantly lower rates to help with that inevitable decline in the labor market?
No, I don't think that's not how I would phrase it. I don't think that's
That's
necessarily
what
the
Moran
case.
is saying, essentially.
Well, he's saying that with small and mid cap companies, if you want to create jobs, one of the things that you need, of course, is more money for the companies to go out there and borrow so you can create a job. So you
Right.
have investment going into that. But I don't think that that's necessarily the biggest issue, to be honest with you. I think it's more just a population that has a bunch of degrees that are coming out of school that are not necessarily built for what's currently required. And especially with AI coming, you're starting to see a lot of the jobs that AI is disrupting. Those people, they're eventually going to work their way into other things. Like, I'll give you an example. When I was in school post great financial crisis. And so a lot of the people, we ended up saying we graduated, right at the, well, we went into college at the tail end of the .com bubble. So a lot of my graduating class went into healthcare.
Yeah.
All right. So like me, I was originally heavily focused on being in tech. So I was actually doing networking classes and everything in high school. And eventually I was like, okay, yeah, maybe I'll go into, like tech when I got out. And then in 2001, the market crashed, right? The tech bubble burst. So now my parents and everyone has advised me like, hey, you should do healthcare because healthcare is an industry that's never going away. You're always going to need it. So I ended up going into healthcare, even though my core focus was tech. Now, eventually I made my way back into tech and with a healthcare focus. But the point is, everyone started doing that. In 2003, everyone started to go into real estate. Like every other person that you would meet became a realtor. And then what happened? 08 happened and market crashed. Now all these realtors, I can't tell you how many people I know that went from former real estate agents to nurses and to PAs after the 08 crash, because that's what, people ended up going towards. So I think a very similar thing is going to happen again, where
But what is that thing that everyone's going to try to get into in this era? Like influencers, AI?
If they're smart, I would say if you're 20 something, you're a young 20-year-old and you're just out of school and you're not finding a job, go into healthcare. Healthcare is one of those things that, there is a, like, and I'm not saying like you need to be a doctor. Like you don't have to be a doctor. You could be a nurse. You could be an X-ray tech. You could be a, what is it?
Sonographer.
A sonographer. Like we met Davis, right? Davis is a sonographer. He's a great guy. Sonographer. They make good money, right? So there are opportunities within healthcare if you're willing to work. No, don't do sonography. That's right. X-ray tech forever, bro. Radiology. But yeah, the point is,
you're saying more people are going to try to find parts of the labor market that are not affected by AI, but you think like a consultant is not safe, in your opinion, over the next couple of years?
I would say that's a very difficult place to be in. Like a lot of knowledge work that you had before is going to be a little bit more challenged. Like I'll give you an example. I was talking, like I asked my Discord people like, hey, I'm trying to develop this debt analysis tool. And I had so many people that are developers reach out to me. I'm like, oh, this is great. Like so many people are in this position where they have the ability to create, these applications. They're able to, create websites and everything else. But I'm like, how many people in terms of tooling do we actually need to do that in this new world of AI and LLMs? Like it's pretty insane. The productivity boost that you're going to be able to utilize with AI.
Right, you can code it yourself just by asking ChatGPT. You don't really need a developer.
Yeah. No, exactly. I mean, if you're a good coder, dude, you're going to be a 10x coder with AI as assistants. It's going to be so the productivity boost is insane. So someone said someone said something funny in the chat. They said, nah, healthcare, you get too overworked. Absolutely. If you go into healthcare, you are going to work. But what's better, starving or working? Right? Because if you don't have a job, rent is due, and you got to feed a two-year-old kid, I'm sorry, you better go and hustle and get yourself a job. And so a lot of people, what they'll end up doing, and this is the pipeline that I've always seen, they'll pick up a job working at like a restaurant or something that's, just a little bit more service oriented. And then at night they'll go back to school, get trained in some healthcare field, and then work their way up. And now they mold their profession into that. And that's what I did too. dude, I didn't just say, hey, Kris, I'm gonna, you know, yeah, I'm not gonna go into the whole story of how things ended up with me. But the point is, people work their way into the sectors that need the labor. Like,
Okay, last question on labor market, then I want to move on to valuations. Do you think AI will create more jobs, and we're too doomeristic about the labor market?
Yes and no. It's going to create more jobs doing other things that we might not have necessarily guessed, and it's really hard right now, as very, very early, to figure that out. Like in the year 2000, and I can only speak to because I was there in the year 2002, 2003, when the entire like IT sector all collapsed. There was no way you could have said that influencer was going to be a thing. Right now, everyone's like, hey, I can be a YouTuber, I can be an influencer, I can do this, that, and I can actually generate money. In the year 2002, 2003, that wasn't even a remote thought in people's brains. Now, the question is, what is going to happen with AI, and how is that going to end up playing out? The other challenge, though, Amit, is that our population is declining.
Yeah.
Okay.
Yeah.
Like the population is aging, and the newer generation is not reproducing at the same level. So the amount of people is actually shrinking. So the question is, maybe we actually do need AI to, I don't know, like keep our luxurious lifestyle in working.
We need it to be a deflationary force that gets costs to come down, and potentially the robots, end up being a way to service the economy as well. Do you think about older people in the economy, people in their 50s and 60s, like my parents that are still working and probably a decade away from retirement, maybe 15 years? What happens to them? And do you think that is something where, like, those are the people with the kids that you're talking about? Do you think there could be a reckoning in that environment that the government would have to get involved in to be able to solve?
Well, that's actually the third leg of what I was going to talk about, which is, if you look at the demographics that we have, the three things that have been propelling people from, propelling the economy, you've got one, a strong labor market. So because of all the hiring at post-COVID, all the stimulus from the government, you had this jobs market that was super tight. If you wanted a job, you could get a job. It was so good. So number one, people have excess money. And then you had all these government supports where if you didn't want to pay your mortgage, the more FHA would do like these mortgage workouts with you and everything else. And then there were rent moratoriums out there. So even if you didn't pay your rent, so a lot of people were flush with cash. And now what you're running into is the situation is kind of reversing, where all these supports are being taken out. And so the labor market is starting to go the other way. Shelter, which is another source of wealth for a lot of people, especially a lot of boomers. Like your parents right now, they bought their house. A lot of their net worth outside of their stock market gains, thanks to you, is probably the value of their home, right? My in-laws, their biggest asset is actually their home that they paid off. It's a paid off home. It's a nice place in Georgia, right? So their biggest asset is that. So if that value of that home starts to go in the other direction, you got a problem with a lot of these older folk who've basically nestled away their homes. Yeah, older people lose homes, foreclosure, housing market takes a dump. Yeah. The other thing is boomers, they have the option to sell. The problem is, where would they go? Like a lot of the housing market was broken because what happened was home prices absolutely exploded. So usually what you see is this migration where older people, they've lived in these 4 or 5 bedroom homes. And then as you get older, you sell that 4 or 5 bedroom home. You have this nice profit, capital gain that you have. You can take that and then basically downsize. The challenge is the last 4 or 5 years, you couldn't downsize because the cost of moving to your new home would actually be more expensive than leaving your home right now. So a lot of these people are just staying still. The current situation is a lot of boomers are passing away. They're passing these homes down to their kids. The kids don't have a lot of kids. They don't need the space. And a lot of them are putting their homes on the market. So I think we've got like about 5 years worth of, maybe even 10 years worth of homes that are going to be coming on the market that are structurally not built for the necessities of this newer generation. And I think that's going to be a big 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 issue. But it's not
AKA,
something that we have to worry about.
You think my generation's not interested in buying, so you guys don't have exit liquidity essentially, or you might not have the best exit liquidity.
Yeah, and the thing is, like, your generation, you're loaded up with student debt. Like, you are some of the most loaded up with student debt ever, right? Yeah. You guys are having kids at a much, much later age. You guys are not marrying until you're 30 something. So what ends up happening is now you're draining away so much their income in all these side things that now they, in order to buy a house, I'm sorry to say this, you need to have a partner. Like anyone, I rarely ever met a single person being able to afford a home.
Yeah.
Most homes, you need two people. You need that dual income to make a home situation work. And if a lot of people are not having that dual income, that means that a lot of these boomers, as they pass away, there's not going to be a lot of buyers for this stuff. So I think that can cause a multi-generational situation where we had in Japan. If you look at Japanese real estate prices in the 80s and 90s, it was like up into the right thing. And then all of a sudden, it just went the other direction. And right now in Japan, there are still a lot of places that have ghost towns, where there's barely anyone living there. I mean, if you look at some parts of the US, it's like that too. Like if you drive through these rural parts of some parts of the country, everyone's like, oh, we have a housing shortage. You have a housing shortage. It's like, go to West Virginia. Tell me if there's a housing shortage over there,
No. So then last question on housing. The stuff Fannie Mae came out and said today, which is either wages got to go up, prices got to crash, or rates have to come down. What do you think is the most probable to get the housing market to kind of normalize?
A combination of all three. So home prices coming down 5 to 10%, which is not bad. Median household income gradually rises 2 to 3% every year. And then the mortgage rates coming down from 6.5 to like 4 and 4 or 5, right? I think that does the job. So you don't need one of these things to work. You just need a combination of all three things to work out, and you'll get back to affordability. Look, affordability is naturally going to get there. The question is it going to get there because of a crash, or is it going to get there because the policies that the government is taking are good enough to get us there? I think the Trump administration is right in trying to lower interest rates because that'll buttress the fall in shelter, right? Shelter has to come down. I do not think there's a point where shelter can sustain at the current level and keep appreciating for what it is. And I'm sorry, I know a lot of people are in the home, are homeowners in here, but just letting you know, if you bought that home to live in, you got nothing to worry about. It doesn't matter. The people that have to worry are a lot of the investors who are not cash flowing. So not only is your asset not increasing in value, you're also not generating cash flow. And that could be a bigger challenge.
That's fair. It is a fair point. Valuations, let's get into that discussion. And I'm going to put a poll in the chat because I don't think I've asked this question yet, but this is the kind of chart that's been going around from Goldman Sachs. I guess answer it however you like, Kris, but are we in a bubble?
Yes and no. Yes and no. The way that I would best phrase this is there are pockets of overvaluation, but they're not in the biggest winners that you're seeing here, right? With the exception of Tesla. Don't hate me, Tesla community. I think if you look at the quantum names, in my opinion, quantum is a bubble. I know some people are really big believers on the technology. Dude, totally understand where you're coming from, but the point is that technology has not been proven yet to justify the crazy valuations that it's getting. Same thing with Oklo, nuclear. Love the concept of nuclear. I think it's going to do good, but look at the valuation on it and the timelines. It's just way ahead of its time. So I don't think that this is the tech bubble of the 2000s where everything is just super overvalued. I think on the other side, it's just there are pockets of overvaluation that the market, if it corrects 10%, it's fine. It's a healthy correction. And that's why if you look at my Twitter, I posted this thing about if you pull it up with Peter Lynch. I think that's one thing everyone here needs to watch and understand.
I'll play this right here.
Yeah.
But you should study history. And history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
Are you saying that sectors eventually are going to have a pretty deep correction in the market? Or are you saying more broadly the market should have that correction?
I think what's going to happen is you're going to see these pocket bubbles pop, and everyone, instead of just saying, oh my God, like I should be buying these great companies that are not impacted, they're going to be selling the general market. And then when they do that, it's like a buying frenzy for us. Because here's an example. You remember post 2001, we had that bubble with all the SPACs, right? All those crazy things.
2021.
2021. But then what happened? All of these other companies started to go down, like Google went down, Apple went down, Amazon went down. These companies are cash flowing. Their business is doing amazing. That's a perfect opportunity to buy the damn dip at the time. So it's kind of similar. I think that's what we're going to get again, where I think there are companies that are very like AI. I think they're going to correct, but the general market will correct along with it. And that's when you want to make sure you have the cash to buy up the freaking great assets at discounted prices. I do think that the mega caps, among them, we could see some major downward moves like Nvidia. And the only reason why I say that is if you look at how semiconductors are, they're a cyclical business. And so if majority of Nvidia's revenue is coming from chip sales, right? Eventually that chip sales growth will come down. I mean, look, if the hyperscalers are having to go into the corporate markets corporate debt markets in order to finance AI construction because they don't want to feel left behind. Eventually shareholders are going to put a pause on that. Like, I can't believe Zuck came out and said, I don't mind losing $200 billion not to fall behind. I mean, that's not something a shareholder wants to hear, you know?
But on the flip side, don't you think that's how motivated all these guys are to keep spending, which keeps this going a bit longer than what you think it could be?
Well, that's the problem, right? Where you can't overdo things because your competitor is overdoing things, right? So that's how these guys got into the trap in the first place. Google was hiring people in, and Meta said, well, we're going to hire all these people so that they don't end up all at Google. And then Microsoft started hiring all these people saying, we want to make sure we have the talent. And then what did we have in 2021? We had this over hiring binge. And then all of a sudden now they had to lay a whole bunch of people off. And it's kind of the same thing, I think, with the AI built up. Right now, there's so much demand out there that everyone is just saying AI. And if there's any indication that maybe AI's growth is slowing down, and investors start asking these companies like, hey, where's our return on investment that you like? If you look at Meta, dude, they've drained their entire cash pile. Meta had a huge cash hoard. They've drained it because of their AI spending, right?
Well, see, that's why I'm saying the Gemini thing is bearish. I'm like, how did they do all that? But they have to use Google. But no, I get your point. Ultimately, they're spending a ton. Look, so then the OpenAI NVIDIA deal, what did that signal to you? Because to me, that signaled that if you think the cycle has 18 months left, maybe it has 36 months left instead.
They're forced into partnerships, in my opinion, because of just how strong Google is and how vertically integrated they are. I'm sure that Jensen, Ellison, and Sam Altman, they got together. And there's this saying that Ben Franklin said during the Revolutionary War: either we'll, what is it? Either we'll something about hang together. I remember. Hold on.
Wait, hold on. I got it. Either we must indeed all hang together, or most assuredly we shall all hang separately.
Yeah, exactly. So that's the exact situation that's happening right now, where if they don't get around freaking Google's gonna eat their lunch. So they're like, listen, let's all boost each other up. OpenAI wants to stay on the cutting edge. Nvidia needs to sell its chips to maintain its valuation, and Oracle does not, has the ambition of getting into the becoming a much bigger piece of the hyperscaler market. So everyone is, the problem is everyone's going to be trying to maximize their margins along the way. So Google does not have to worry about that because it's all one line item for Google.
Yeah.
So.
Well, in the midst of that though, and I think that quote is an accurate comparison here, it still seems like there is a lot of spend over the next at least 3 years that is being implemented, which means there's a lot of opportunity for investors. Like I don't think Nvidia is top tier, is what I'm saying.
Yeah. I don't necessarily think that either. I think there's also, remember, now it's going to broaden out beyond just the US as well.
Yeah.
Right. So you're seeing, I spoke to someone, they said they're building a lot of data center stuff in Europe now as well, and other parts of the world. So there is definitely going to be demand. Like, no one wants to be 100% dependent on American big tech. Like, there's a lot of companies in Europe. They're like, we need our own like ecosystem of AI. And I think Nvidia is being smart and saying, look, we'll give you the chips, become dependent on us for the chips.
Yeah.
So I think that's the next phase. So I don't think that this phase of AI growth is over by any means. I just think eventually people will ask for an ROI on their investment. Do
you think there is a big ROI at the end of this tunnel that we're going to be able to be like, yep, that's why we built out and we spent hundreds of billions of dollars in the first place?
There always is. I mean, this in my opinion, this is all natural progression, right? Like, you look at the railroads in the 1900s, we overbuilt the railroads, but what did we get? We got the best rail infrastructure in the world at the time. We had the .com bubble happen, right? Everyone built out fiber, but then what did we have? We had capacity that made us the top internet company the country with the most amount of internet connections everywhere, So right. I think from an economic standpoint, yes, could there be overspending in AI? Absolutely. But I think the ultimate benefit is going to be the American economy, because there's going to be offshoots that happen because of AI, maybe in robotics, maybe in autonomous cars, like this is what I love about America, bro. We are always on the cutting edge of everything because we're willing to risk capital for a prolonged period of time, and we're not looking for an immediate ROI.
Yeah. Well, that's the whole point of VC, right?
Say again?
That's the whole point of VC. They're willing to subsidize OpenAI for so long until, OpenAI is going to be $1 trillion IPO. And like, that's going to be amazing for people that bet on it when it was worth $15 billion, right?
Yeah. It's funny. There was something I actually spoke to Sam about yesterday. A lot of companies, they're getting these really high valuations. And did you see the thing that Andrew posted on their Twitter thing?
No. What do they post?
Check out my Twitter thing. I actually quoted it. They actually did this quote from Silicon Valley. What the problem that you run into a lot of times, this happens in the private markets, but it also happens in the public markets. So just go to the Twitter thing and you'll see, I think it's from John. Yeah.
I don't think YouTube's going to nuke us if I play this. So hopefully
yeah.
Right.
No, just go down. Go down.
Oh, just go down? Okay.
Yeah, that right there. So right now, the founders, beware of the kamikaze round. This is a very important concept, because what happens with a lot of founders is that people get ahead of the valuation, and then it's literally a race to the bottom. Now you can play that clip, and I'll explain it afterward.
Okay.
Truth is, I'm actually doing okay.
Good. That's great.
I mean, I can run the scenarios of what happened all I want, but I finally just realized there's just nothing I can do, Yeah. So I'm at peace with it all.
I was thinking actually, what if you had asked for less?
What?
Well, what if you could have gone to someone and asked for less than what they offered that first round?
Like, you mean negotiating them down?
Yeah.
Can you even do that?
Well, yeah, I mean, why not?
Yeah, but I mean, I guess technically I could have. Huh. Yeah, I suppose you could argue that it might have been easier to hit more realistic benchmarks and reach cash flow break even.
Yeah, that's what I'm saying.
And then we wouldn't have faced that down round. And we wouldn't have had to settle for acquisition. All that money fucked me. Shit.
It's basically founders realizing. So you're saying there's a lot of AI companies that are taking a lot of big checks and they can't live up to those expectations.
Yeah. Well, it's not that they can't live up to them. It just sets a really high bar for them in the future. And so when they can't live up to them, it looks like they're a shitty company, right? So right now, like if you get value, like Andrew right now is like basically valued at $50 billion. It's still in the private markets. It's crazy that its valuation is that high. And so now the expectation is when you IPO, it's going to be like, hey, you're going to have so much cash flow. You're going to be doing this, that, and the other thing. And it sets things up really badly for the founders because now they have to take a lot of measures in order to keep that growth going. And sometimes that means that investing in things that may or may not work out from a bottom end perspective, but shows top line growth. So it's kind of similar in Sam Altman and these guys. The valuation of OpenAI has blown up so much that now the expectations of OpenAI have gone absolutely berserk. So even a slight KPI miss, and it's like, oh my God, this is a shitty company. And now everyone's like out for blood, right? And that happens in the public markets too, where people will bid up a company's price so high and the leadership is like, God damn, what do I do now? Right? The expectations have been set really high. And when they can't meet those unrealistic expectations, the stock crashes and people are like, how come you didn't maintain a 200 PE? Like,
not possible. Yeah.
You're not a good CEO. You can't maintain a 200 PE. It's like, no, they're a good CEO, but the market is stupid. And the funny thing is they can't come out and tell the market, hey, listen, stop buying my stock. You guys are overdoing it. People are just, hey, listen, take my money.
Okay, so in wrapping up the conversation around valuation, essentially you think there are some stocks that are obviously overvalued. There are private companies that are overvalued, and either they really grow into the valuation in order to maintain these multiples, or they don't, they crash and burn. That probably leads to good companies like a Google, Meta, Amazon getting sold off. And that's when you swoop in and you buy as much
exactly.
Okay.
There's also one last thing, and this is something that maybe we'll talk about in the next macro thing. There is a major problem in private equity, and no one seems to be talking about it. So that's something that we can hopefully continue on. Yeah, it's crazy. Like private equity is in a really bad place, and a lot of GPs are having tough time funding things. So
okay, one last thing, you put this in your risk section. I guess this is the last thing we'll talk about. Weakening of the consumer could lead to underperformance of market leaders. Do you think there's an issue with the general consumer right now, or is the consumer with retail sales holding up?
So it's sort of a cascading thing. So the bottom half right now of people are not doing so well. They're getting crushed by inflation. The job picture is going in the wrong direction, right? And then you have the middle parts, which are, your average people just working a 9-to-5. They're just getting crushed by inflation. They still all have jobs, so they're at least their head is above the water. And then you have the top 10%, which are doing absolutely phenomenal because they have the tailwind of the stock market behind them. Last year, they had the tailwind of shelter behind them, and they had the tailwind of high-paying jobs behind them. So as each, if you look at the top echelon of the people, they have great jobs, they have great homes with a lot of equity, and they have a stacked portfolio. But the thing is, each one of those layers, as they chip away, they impact that section. The lowest part of the equation, they tend to have, as long as labor market is fine for them, they'll keep spending. But if labor market weakens, their spending goes down. The middle side, they have equity in their homes. They have stock market gains, but they have their thing is okay for them. The jobs are okay. Now jobs are going and housing is going at the same time. So now they're just relying on their stock portfolios. And then you have the upper level. They had all three before. Two of them are gone. And now all they really have is that stock performance that's keeping up. So if the stock market starts to decline, that spending is going to come down. And so now you're going to have all three of the major branches of the consumer go down. And the challenge is, if you look at like Google, Microsoft, Amazon, all these things, they may not be directly influencing consumers. But remember, everyone who pays them, all the people who do ads, all the people who do enterprise licenses for software, all of that money is coming from the consumer spending. The consumer spends, it goes to a company, that company spends on Google, spends on Microsoft, spends on Meta and everything else.
But,
and then
you saw PCE, you saw PPI, you saw retail sales, you saw consumer expenditures this morning. Doesn't look like consumers that bad, right? Or do you think it's being subsidized by the consumers that have assets?
Yeah, I think it's being subsidized by the people at the top. The people at the top are so flush with cash. I think that the spending was like 50% of all spending right now is coming from the top 20% of people.
Top 10%.
The top 10. So you go to, and it's actually noticeable in the restaurant figures too. Like if you go to like McDonald's and Chipotle, their same sales volumes are down. But then if you go to like a really nice restaurant, it's packed. You remember when we went to the steakhouse in Vegas? And that was a very weird situation where the casino that we went to for the conference, which was like more of a budget casino at the Virgin Hotels, the entire casino was empty. Right. But then when we went to the Wynn, which tends to cater to the more higher end of the consumer, it was packed that night that we went. Right. So you can see the top 10%, they're doing really well. And the reason why the top 10 are doing so well is because they're heavily tied to the stock market. So if the stock market goes, that 10%.
Okay, so here's where this becomes fun. Do you think, because everything you said, I 1000% agree with that, if the top 10% are making up the overall 50% of spending, that the Trump administration makes sure the stock market doesn't collapse, because if it does, all that spending goes away and then you have a recession. Is there
why do you think they're trying to lower rates? They're trying to buttress this economy. They're like, bro, not to mention they want to help. They really need to help the bottom end of the consumer. Now, they don't want to do it via direct cash. They just don't want to say, here, you know what? You're at the bottom, you're struggling, here's money. Because if you do that, you're just creating another generation of people who are, government subsidized.
Also, we don't have the money to do that. We don't have the money to just give it away.
We could always print more and just give it to them, but that's not a long-term solution. The long-term solution is getting people to get jobs that are meaningful, impactful, and at the same time, actually people can save money, have some money, socked away for retirement. You really don't want to create an entire generation of people dependent on the government. And I think that's one of the things that the last administration tried to do. And that's something that even Coach Strap, remember, I think we spoke about a couple of years ago, which was, you don't want to create a situation where it's a hand-to-mouth situation for consumers, where literally they're just getting everything. Oh, you housing? Here's Section 8. Oh, food? Here's food stamps. Oh, you don't have money to spend? Here's cash, and it's like welfare checks.
So do you think the intent on cutting rates, and Trump's been bragging a lot more about the stock market, is intentionally trying to make sure that, yes, the lower end of the consumer has a little bit of a break, but also the top end doesn't collapse? Because if it does, you're right. I feel like the whole party comes to a crash pretty quickly.
Absolutely. Same thing with housing too. Remember, like, you have to make sure that housing doesn't go down 25%. You can sustain 10% drawdown in the housing market in most places, but you can't do like a 25% drawdown. If you get a 25% drawdown on housing, you're going to get an 08 like crash. And a lot of exposure is going to come back to Fannie and Freddie. So you really don't want to go that route.
So let me ask you this question, because a lot of people have been thinking about this. Do you think being an investor is one of the ways to save yourself from whatever unknowns exist in the world of AI commoditizing the labor market? Like, do people just have to be long stocks?
I'll tell you one thing. I looked at my paycheck the other day and I saw my like after taxes how much I end up with. I would not be in any sort of comfort in life if I did not invest. Okay. I work, I do okay. Like I have a great job. It's still in the public sector, so it's not like the greatest pay in the world, right? But it's still good pay. But if I had to make do with just that income, and like let's say my wife lost her job, whatever, I would go from having a good life to a really, really difficult situation very quickly. And I think a lot of people are in that position where one partner loses their job and now all of a sudden, they can't afford the basic necessities anymore. So so I think that's a challenge. And I think sorry, I got lost in train of thought. What's the question?
The question was if people don't invest, you have Vlad coming out saying like, hey, investing could be a profession one day for everybody. Because like, do you think people have to be long assets at the end of the day?
Yeah, absolutely. The greatest equalizer in terms of wealth is the equity markets. The only thing that I would caution most people is not to try to do it professionally, instead just to index. Like I would say 90% of people who have the temperament to actually do this full time. The other 10% of the time, the other 10%, yeah, I think only about 10% can actually do it professionally. Everyone else should just literally index and chill. It takes a lot more work than people think. It's not as simple as just, hey, I need to just buy this company or that company. Like there is a lot of due diligence that goes into picking great companies and not getting caught with a bunch of shitty companies and then getting caught in cycles and then dealing with the stress of all of that shit. So I think most people should just index and chill. And if you literally have the compounding wealth effect between 7 and 10% per year for the next like 20 years, you're going to be fine.
Yeah.
100%.
100% agreed. All right, Kris, one last question for you. Thank you, everybody, for being here. This is the first Macro Thursday. We'll be doing this every single Thursday, 4:20 to 5:20. Yeah. Thanks for the $20 super chat. Usually disagree with Kris, but have to agree I'm long. Latinas. That's nice to know. BMNR. This one got hit today. Yeah, your options are probably getting hit along with everyone else's stock.
Yeah.
What are you thinking? Are you buying more? How are you navigating it?
I'm not buying more, but I think that there will eventually come a bottom sooner rather than later. I think we're just seeing some September drawdowns, but I think we'll have a good October, November, December, especially considering the Fed has already said we're going to be cutting into this, right? So as the Fed cuts, you'll see asset prices recover nicely going into the rest of the year. So I'm not worried at all.
That's a pretty simple thesis. Rates come down.
Don't fight the Fed. Like, how many times we got to remind people, don't fight the Fed. If the Fed is saying we're lowering interest rates, chill. Like, it's one thing if the Fed is like, I don't know. Now, all of a sudden, they're all like, yeah, 3 cuts. Maybe another 3 next year. Like, no. Just chill. No. Just, don't fight the Fed. That's all I'm going to say. And not to mention, Santa Claus rallies are there. I think with Tom Lee, the strategy of the Ethereum treasuries is something that if you look mathematically, as long as they can maintain that MNAV at about 1.5, they can keep issuing shares and keep accumulating the ETH. And I think eventually, once the stablecoin legislation comes around, I think more people are going to be piling money into Ethereum and Bitcoin and everything else. And you'll see the value of the underlying asset rise. And if the underlying asset rises, if you do that same MNAV, you're going to see a move up in BMNR rather quickly. Yeah. So, yeah. Because remember, right now, you kind of want to see Ethereum prices down. Yes. Why? Because that means that you can accumulate at a cheaper price. The biggest thing is just making sure that MNAV does not shrink for BMNR. Now, what does that mean? That means that right now, if you look at, can you go to BMNR rocks? I mean, BMNR.rocks. It's a funny name. Okay. So you see that thing on the left-hand side, the stock price and the price of Ethereum, right? So you see that wide gap between the price of Ethereum, the other one. Yeah. The wide gap between No, the other one. Go the other way. Yeah, there you go. The wide gap between Ethereum prices and at the same time the stock price. So Ethereum prices are coming down and the stock price is coming down, but they're still able to maintain that MNAV. So there's a multiple. There's a spread that you're getting. So right now, Tom Lee is still able. Right now, you see that 1.42, still able to issue shares right now and buy Ethereum at a discount. Okay. Now, the thing is, once over time, that MNAV difference should theoretically shrink and get closer to a 1. But until that happens, right now, this is great for anyone who's trying to accumulate. And what's going to happen is every time you issue something for $1.50 and you're buying $1, you're basically putting that away into the balance sheet. And so your balance sheet is going to keep going up and to the right in terms of total ETH ownership. Now, if Ethereum goes to, let's say, 5,500 by the end of the year, all of a sudden, all that Ethereum that you bought at 3,900, it's a lot more valuable. So now what happens to the stock? The stock goes up too, right? And so that's why a lot of these institutional people are willing to give them a premium to their current net asset value, and it's a significant premium over net asset value. So
Correct.
Yeah.
All right. Thank you, Kris Patel. If you are not following Kris on X, please make sure to follow him. I think people really enjoyed this segment. I've missed our hour-long macro discussion, so I'm happy we have a formal place to do it now. And we'll keep doing it every single Thursday.
Later, guys. Yeah, we'll keep you up to date. By the way, maybe we should have like I don't want to call it a gossip section, but a gossip section about what is it called? Twitter beefs. If you see the Martin Shkreli thing happening with Quantum.
Dude, it is ugly. Look, I don't want to get into the drama of it, but it's pretty ugly.
Dude, everyone is coming after Shy right now about the Quantum thing. But theoretically, Shy's been right about Quantum's value.
Well, it's funny, right? The stock has gone up and he's still taking all the shit because everyone believes it's a bubble. I mean, I saw this part of the interview. I haven't watched this in like a month. This 30 seconds.
I think you're showing the wrong screen. Sorry.
No, I'm right here. I was actually crying when I heard this part, bro. This part was the funniest part to me.
Because I know people like you, and it's going to take a lot of exhaustion, mental capital, just to even entertain.
You just have to provide one interesting intellectual point.
That's what I'm saying. You added intellectual point. You're calling me a fucking idiot.
Yes.
You don't know how to handle yourself, and I'm down with you. I don't want to interact.
You're quitting. I get it. You checked out. You're quitting. I got it.
Okay.
It's supposed to be debate, but you quit.
Sure.
Dude, he said, you just have to provide one intellectually interesting point. First of all, that sentence in and of itself is like, whoa, like you just called him an absolute idiot. But he didn't call him an idiot. He said, you're not intellectually interesting. And then Shy's like, wait, you just called me a fucking idiot. He's like, yeah, because for 40 minutes you said nothing. But Shy was long IONQ from like 6. It's at 70. Martin's the one who's not made money on the short. But public opinion is on the side of Martin because everyone thinks this is a bubble and it's going to collapse. And eventually we're going to see how it plays out.
Yeah. I think this is the challenge, right? In the short term, someone could be right. And in the long term, they could be absolutely wrong. But we'll see what happens, Yeah, but it's interesting how these Twitter beefs just randomly like pop up. And now, dude, my entire Twitter feed is literally people posting that clip. And I think there's another one the entire time. And I think there's whatever. Like I said, this is just fun segments to cross over into once in a while.
I mean, look, at the end of the day, it's a disagreement about a stock that is causing a ton of conflicting narratives, and it is what it is, right? Publicly, people, if you're going to be a public figure, you're going to have debates about this stuff, and it is what it is. People are going to, disagree.
Yeah. Yep. All right, brother.
All right, Kris. Thank you. Appreciate you, man. Later.
Okay.
All right, folks, we are done. I am really happy with the segment. I'm happy we are having a dedicated section for macro. I mean, Kris is just so good at breaking down a lot of stuff. Whether you agree or disagree with him, his ability to distill the information and like break it down and give a perspective, I think is very, very important. And obviously, he has helped me understand the macro a lot better over the past couple of years. We are done. Watch this go on for another 30 minutes. No, we're actually done. It's a 2 hours into the day. I think we're good for now. Yeah, that's pretty much it. We don't have anything else. I mean, Costco earnings, that was it. Costco didn't do anything. Down 1%. But outside of that, we are pretty much good. So there you go. Amit, don't leave. That's it. We're done. We are officially done. This quantum thing is blowing up on Twitter, though. People are just so crazy going back and forth about it. And it's funny because it's like Shai has been right the whole time. He's up on the stock. He's made a shit ton of money. Martin has not made any money on this short, but like everyone thinks that eventually it's going to come collapsing down. It's like, what if it doesn't? What if the retail investors inside of these names are just able to hold on and they don't really care about anything else? Or what if it does collapse, but then Skrelly's not actually short when it does collapse, right? Because that also could happen. So there's just so many different ways this could play out. But a lot of people are thinking of it. Siege, thank you for the $20 super chat. I have nothing to add. Appreciate you, man. Thank you for being here. Dude, we've had Steve on 3 times this week, and you guys are saying to call Steve. Like, the dude is probably, usually he just calls me, but he's probably busy. It's a Thursday. He's usually on Friday on the close, so he'll be on again tomorrow. He's been on pretty much every single day except today. Yeah, literally he's been on Monday, Tuesday, Wednesday. Oh, money market flows. Let's see. All right, I'm going to do it with you guys in real time. Put in the chat, increase or decrease. I haven't seen it yet. Increase or decrease. I'm going to literally share the screen as soon as I click the website. Put in the chat, I'm going to go decrease. I'm going to go decrease. I'm going to go decrease. And we're going to see. His reaction to Costco earnings. I don't think he's going to care about Costco earnings. He did buy more BM&R today, though. And ETH. Okay, increase, decrease. I think it's kind of 50-50. I'm going decrease. Let's see what we got. All right. Opening it at the same time as you guys are seeing it. Increase. 31 billion. Huh. Looks like some people got scared. Or it could just also be the interest on the assets in and of itself. But you did not have a sizable decrease. Last week, you had a 15 billion decrease. Even with rates coming down, this is the first week after rates coming down. 31 billion when it's money market. By the way, I think Hood just emailed me today. Let me know if you guys got the same email by your savings account. They're lowering the 4% to 3.75. Let me try to get the exact date on when they're doing it, but that is officially happening. So if you were getting that 4% yield, it is coming down. Yeah, it should be. I think it's like in like, is it already official? It's already 3.75? Oh, yeah, it already is. Yep. The email says it's live right now. All right. So everyone's getting 0.25 bips less. SoFi has had 3.75 for a while, I think. Is SoFi lower than 3.75? Hood just went there. One other thing about Hood, Vlad tweeted this just now, and I didn't know this was happening, but looks like that credit card's rolling out, folks. Look at this. Finance United States, Robinhood number 14, Robinhood credit card number 18. Number 18 in the entire country in finance. We're talking about tens of thousands of downloads a day. So I would imagine the credit card is being rolled out to a lot more people. And that's a good thing because I think that's the Trojan horse into banking. And then obviously brokerage as well. So it looks like they're getting a lot more people onto that card, which is good. And hopefully that continues to expand. So there you go. You can deposit $2,000 for a boost to 4.25. Yeah, they always have those little offers where you can deposit some money and then it changes. I just had a friend get approved today. Yeah, it should be a lot more people that are getting off the list. And there you go. K. Roger, thanks for the super chat. Live on CBC right now. Feds talking, hence market red. That was a funny video yesterday. That was a funny video. It's just more people getting into the markets. More people that care about stocks. Dude, I was serious about the friend who FaceTimed me. I don't think I've talked to him in a year, and he was FaceTiming during the Tom Lee clip. That's why I paused. And I was like, yo, what's up? I'll call you in a few hours. He's like, just saying hello. If he asks me about Oracle, I'm going to lose my shit. He's like, so what do you think about Oracle? That would be hilarious. That would be hilarious. Bro just keeps streaming because we are his friends. Oh my gosh, bro. Margin rates are down. Yes, I mean, everything comes down, right? When rates come down, everything comes down. Althouse says I have 30 minutes left on my flights. Dude, the fact that flights, bro, you know the rabbit hole I've been getting into is, I don't want to say this, Altau, because you're on a flight right now, but like I've been like just like seeing these videos of like flight crashes in the 90s and 80s when the technology wasn't as good as how it is right now. And like, bro, like Japan 123, that flight, like some of that you can hear the black box recording at the ends. Like, it's kind of wild that we get on flights and that we literally, go across the world and we arrive. And it's like, there's, things have happened in the past where it just didn't work out. So that's one rabbit hole that I've been going down. But, most technology is a lot better than what it was back in the 80s and 90s. And planes are getting better as well. I have not seen Final Destination. I've heard of that. Is that a movie? Final Destination? Dude, why do they have so many of this? Final Destination 1, 2, 3, 4, 5? Final Destination Bloodlines? No, I've never seen this. I've heard of, like, the name Final Destination. I have not watched it. I've not watched it. See, I was going to say, I'm not trolling. You guys think I'm trolling? I legit have, like, these are things I just haven't watched. Are you serious? Yes, I'm serious. Well, is this like a cultural phenomenon, Final Destination? American horror franchise that includes 6 films, 10 novels, 2 comic books. In addition to films, novel series consists of 6 original stories. Yeah, I've never seen this. I'm not a big horror guy, bro. Like, scary movies are not my thing. Like, I don't want to be scared when I'm watching a movie. Like, I don't know. That's just not like, I want to be intellectually stimulated. I want to like think. That's why Inception, Interstellar, those are the movies. Not, you got to be, I'm not trolling, dude. I have not seen this shit. The only scary movie I've seen is It. Do you guys remember that? It, scary movie? Yeah, 2000. This was a while ago. It was like 2015, 2017. Yeah, this was the one I watched that was scary. Otherwise, I haven't seen any super scary movies. Amit's idea of a horror movie was watching Stocks on Liberation Day. Dude, do you guys remember those days? I remember those days. We got to get a compilation of clips from like the first couple days in April. Like, shit was ugly. Ugly. And we all somehow lived through it. Ken Griffin discloses stake in ETHZilla. Okay, that makes sense. Citadel probably getting into the game of market making for ETH treasuries. So that makes sense. Bro, people really want the card. Look at what someone tagged Vlad in. Grandma says, stay in the cage until I get the gold card. Your move. At Vlad at Robinhood. And Vlad is like, dude, people really want. There's 3 million people on the gold card, on the wait list. So it looks like they're starting to roll it out aggressively, which would be good for everybody. Do they make Indian horror honor films inside of a 7-Eleven? I don't think they do. I wouldn't think so. All right, are we done? Are we good for the day? Are we out of here? I think that's it. I think we're done. Dude, tomorrow's Friday. We're not done with September, but tomorrow's basically coming to the end of September. And yeah, we'll be done. Be done for the week. Be done for the week. All right, cool. I think that's it. I think we're done. I wore that ridiculous suit to the meetup. I could get photographed repping Robinhood Gold and it didn't work for me. Dude, Doug, we got to get you. We got to get you somehow this card. Friday flush. I mean, if it happens, it happens. If it happens, it happens. It is what it is. We'll deal with it. Call Steve, dude. Steve's in the office today. I don't think he'll pick up, but let's see. We'll ask him about Costco if he does pick up. We'll see. I got approved for the card a few days ago. Yeah, it seems like.
Hello?
Yo.
What's up?
I'm live.
Of course, why wouldn't you be live?
So the chat really wanted to tell you something.
Okay, what does the chat want to tell me?
Well, your favorite company beat on the top and the bottom.
Oh, I already got blown up about it.
Really? People started texting you about Costco?
Yeah.
Okay, well.
Yeah, great. I don't care if they beat on the top and bottom. I hope they do. They just shouldn't be more expensive than NVIDIA on a valuation basis.
Well, we're just letting you know that Costco had a great earnings.
What are you doing for dinner tonight?
Dude, honestly, I'm happy you brought. My stomach has been hurting for the past couple hours, and I don't know why. And like, I don't think I'm eating dinner tonight.
Well, that's a shame. I'm about to make some steaks.
Oh, I thought you were gonna say that's a shame. I wanted to go out tonight with you, but you know, that's not what you said.
You're not in the city, and
I could be in the city pretty soon.
Yeah,
I can get to the city.
I'm already done with seasoning, getting the garlic butter out.
You're eating steaks?
Yeah.
Medium rare, or is that how we're doing it? Or
yeah. Why wouldn't I be doing it medium rare?
I don't think that's the right way to do it, but it is what it is. But
you are in the minority, sir.
So you're making steaks tonight. What are the sides with the steaks?
There's no sides.
There's no like mashed potatoes or broccoli or anything like that? Or?
No.
You're just gonna eat the steak, that's it?
Yes.
So you don't eat anything with the steak?
No, my wife is not home. She's out, and I am gonna make a big steak for myself.
Okay. We could get some Costco pizza instead.
Absolutely not.
Dude, their pizza's legit. Their pizza's actually
do not disrespect good pizza like that.
I'm not saying it's the best pizza in the world, but it's not bad pizza. Like
in a pinch, maybe, but no. Like you're not going to Costco to go eat pizza. So no, it's not good. If you're there and you're hungry.
No, my sister and I have definitely gone to Costco and to get a slice of pizza.
You have not gone to Costco to go eat pizza. Stop it.
Okay, we're probably doing groceries at the same time, but still.
Okay, and I'm not gonna make fun of that because in a pinch, if you're hungry, okay, grab a slice and a Pepsi, sure, whatever. But nobody in their right mind that lives in New Jersey that has good pizza all around them is going to Costco to go seek out pizza.
That's
just
fair.
not happening.
That's fair. That's fair. That's fair. I'm not gonna. I've never heard that in a pinch. What do you mean by? I've never heard that phrase.
In a pinch, gotta get something quick. You're in a pinch.
Has anyone heard that phrase? I've never heard in a pinch.
You've never watched any movies. Why would you hear that? You didn't even know who Tom Petty was.
That doesn't mean in a pinch is used in a lot of phrases in movies. Like, by the way, have you seen Final Destination?
A long time ago.
Okay, I just found out there's like 7 of them. So, yeah, I might watch it. I don't know. It's kind of scary. But
what did you watch last night?
Nothing.
I went to sleep.
But what did I do last night? What did I watch? No, nothing.
Right, you went to sleep.
I think I fell asleep to like a podcast playing in the background.
Of course you did.
Dude, I listen to a lot of podcasts. That's what I fall asleep to.
Yeah. A good role model.
I'm a good role model. All right. Well, enjoy your steak. We just wanted to tell you about Costco.
No, I appreciate it. Costco to the moon. Let's go.
Costco to the moon.
And Ethereum is now an official bear market, according to Peter Schiff.
According to who?
Peter, whatever his name is.
Oh, Peter Schiff.
Peter
Dude,
Schiff.
this guy's been
Schiff.
bearish Bitcoin for like 15 years. I mean,
Yeah, it's the gold guy.
gold's
The
done well. It's just,
Gold guy.
yeah, Bitcoin's done better than gold. But no, even Kris, he was just on the show. He was talking about he thinks BMNR is going to be fine. ETH's going to be fine by end of year. So
yeah, why is anybody nervous? Doesn't make any sense.
yeah, I mean, to me, the entire move today was just broader September action, and that's kind of what we got. What price did you get it at today? For under 50 or above?
Yeah, 49, something like that.
Okay, that's fair. That's fair. All right, thank you, Steve. We'll see you tomorrow on the market close for Friday.
All right, you stay out of trouble.
All right, talk later.
Later.
All right, there you go. He's eating steak tonight. And I should have asked if he got the steak from Costco. That would have been funnier. Okay, now I actually think we're done. We'll be back tomorrow morning. We'll keep it going from there. And yeah. Call Tanner. You didn't say I love you. Yes, I forgot. Forgot to say I love you. All right, cool. That's it. We'll be back tomorrow. I think that's pretty much what we got. George, thank you for becoming a channel member. Appreciate you. Thank you for being here. And that's it. I mean, look, relatively flat week. If you got some dips, that's great. Maybe sold some calls. I know some people sold some puts. It is what it is. But looks like we're ending out the rest of September, hopefully around this range, if not a little higher. If we're a little lower, it's not that big of a deal. And then we get into October. October's got a lot of birthdays. It's got Halloween. It's got, in general, I think, just more festivities. And then we head into November with Thanksgiving and everything. And then you got the end of the year with December. So we are headed towards the end of 2025. And now we just got to see if we can end out in an exciting way. And I think we will. It just might take some time to get there. All right. Thank you, everybody. Appreciate it. Let's practice pronouncing words. I had to ask Kris how he should have said strength. I need to ask him next time. Apparently, everyone says the G, and I don't get it. I don't get why. Oh, yeah. Diwali, Navaratri. I mean, there's so many Indian holidays as well in October. So we have all that going on. Yes, it's my birthday as well, October 27th. Is that a Monday? When's my birthday? I think it's a Sunday. October 27th is a Monday. Okay, it'll be Monday morning. And then Halloween is a Friday. Okay. So that's what we got. And then October 1st, Wednesday. So that's next week. All right. Thank you, everybody. Appreciate it. Love you all. We'll be back tomorrow on the market open. Bye, everybody. Have a good one. See you guys tomorrow morning.